For 70 years, America's banks multiplied and trust companies ballooned. They tempted savers with high rates, but hoarded just 5% in reserve. There was no central bank, no safety net, only faith that panic would never spread. Then in 1907, that faith vanished. As Wall Street stood on the brink, the survival of the entire system would come down to a single man. But what happens when a nation's last line of defense is just one financier? Trust companies swept across New York at the turn of the 20th century, multiplying from just 16 in 1890 to 67 by 1907. They promised depositors something the old national banks could not: 4% interest, double the rates on offer elsewhere. This promise drew in a flood of savings from families, businesses, and even institutions eager to see their money grow. By 1907, trust companies held nearly $1.2 billion in deposits, a sum that rivaled the combined holdings of many of the city's established banks. These institutions were not dusty relics tucked away in side streets. They built grand offices on Fifth Avenue and Broadway, advertising their modern approach and easy access to cash. Their ability to pay out on demand while offering high returns gave them an edge in the battle for deposits. But behind the marble counters and polished brass, the rules that governed trust companies were loose. State oversight was minimal, and their reserves, just 5 cents for every dollar held, were a fraction of what national banks kept on hand. The race to attract deposits pushed trusts to grow ever larger, making them both a symbol of financial innovation and a source of hidden risk as money poured in faster than anyone could track. No federal safety net stood behind America's banks in 1907. Since the closure of the Second Bank of the United States in 1836, the country had operated without a central bank. There was no institution to inject cash or guarantee deposits when panic struck. Instead, trust companies and banks relied on their own reserves, which were thin by any standard. For every dollar deposited at a trust, only about 5 cents sat in the vault as cash. National banks kept more, but even their reserves could be stretched to the limit when fear swept through the system. Most of these institutions used deposits to fund loans that could not be quickly recalled. This mismatch, short-term promises to depositors and long-term bets in the market, left them exposed if too many customers demanded their money at once. The situation grew even more fragile because much of Wall Street's daily trading depended on call loans, short-term funds that could be withdrawn overnight. When trust companies pulled back, the flow of money to brokers and businesses stopped almost immediately. Without a central bank to act as a lender of last resort, a sudden demand for cash could trigger a chain reaction. One institution's troubles quickly became everyone's problem. As reserves drained away and loans were called in, the system's weaknesses became impossible to hide. The absence of a safety valve meant that even a rumor could turn into a stampede, threatening the entire financial structure with collapse. On October 14, 1907, a failed attempt to corner the United Copper Company sent shockwaves through New York's financial world. The collapse wiped out fortunes in a single afternoon and, more importantly, shattered confidence in a web of banks and trusts tied to the speculators behind the scheme. As rumors spread, attention turned to Charles T. Barney, president of the Knickerbocker Trust Company, one of the largest trust companies in the city. Barney's connections to the failed copper syndicate became public just as depositors began to worry about the safety of their savings. By October 21st, Knickerbocker's clearing agent, the National Bank of Commerce, announced it would stop processing the trust's checks. That single move acted like a spark in dry grass. The next morning, crowds formed outside Knickerbocker's grand headquarters on Fifth Avenue. Lines stretched down the block as anxious men and women demanded their money. In less than 4 hours, nearly $8 million drained from the vaults. With reserves exhausted, Knickerbocker suspended operations at midday on October 22nd. Barney resigned, and panic spread instantly to other trusts. The suspension rattled Wall Street. Trust companies began to hoard cash, refusing to lend in the overnight call loan market that brokers relied on to finance trades. As liquidity vanished, stock prices tumbled, and the New York Stock Exchange itself teetered on the edge of closure. The city's financial machinery, so recently fueled by easy credit and public trust, now threatened to seize up entirely. Without a central authority to coordinate a response, fear and rumor alone set the pace for the unfolding crisis. On the night of October 24, 1907, J.P. Morgan summoned the city's most powerful bankers to his private library on Madison Avenue. As panic threatened to bring down the financial system, Morgan's authority was absolute. No one left the room until a solution was found. The doors were locked. Inside, Henry P. Davison, Morgan's trusted partner, moved quickly through the crowd, collecting pledges. The task was urgent. Raised $25 million in fresh capital to prop up the trust companies on the verge of collapse. Morgan gave them 10 minutes. Bank presidents, some rivals for years, signed their names and committed millions on the spot. To decide which institutions deserved rescue, Morgan's team worked through the night, combing through ledgers and balance sheets by gaslight. Only those trusts that passed a rapid, thorough audit would receive aid. The Trust Company of America and the Lincoln Trust, both battered by runs, were deemed sound enough for support. By 4:45 in the morning, the pledges were signed, the money secured, and the city's most vulnerable trust had a lifeline. Word spread quickly. The announcement that the banker pool had stabilized the most threatened trusts calmed depositors and slowed the stampede for cash. For a moment, the crisis receded, not because of government intervention, but because Morgan and his circle had acted as a private central bank. The immediate panic was halted, but the memory of that night, the locked doors, the frantic audits, the reliance on a single financier would not fade from public debate. Congress responded to the shock of 1907 with the Aldrich-Vreeland Act, signed into law in May 1908. At its core, the act granted national banks the power to issue emergency currency backed by a wider range of collateral than ever before. This new flexibility aimed to prevent future panics from freezing the flow of money when it was needed most. But emergency currency was only a short-term fix. The law also created the National Monetary Commission, led by Senator Nelson Aldrich. Charged with studying the world's leading banking systems, Aldrich and his team traveled to Europe, meeting with officials at the Bank of England, the French and German central banks, and gathering ideas for reform. Their mission was clear. They aimed to find a way to strengthen America's fragmented financial system and avoid another crisis like the one Morgan had just contained. The Commission's findings would soon become the foundation for a much deeper debate over the future of American banking. Congressional investigators soon turned their attention to the roots of the panic. The Pujo Committee, led by Congressman Arsene Pujo, began digging into the tangled web of directorships and alliances that ran through Wall Street. Their final report, released in early 1913, revealed that a handful of powerful men, many tied to J.P. Morgan, sat on the boards of 112 corporations, controlling more than $22 billion in assets. This concentration of financial power, labeled the money trust, fueled public outrage and calls for lasting reform. Lawmakers pressed forward. In December 1913, President Woodrow Wilson signed the Federal Reserve Act into law, establishing a central bank with the authority to issue currency, manage reserves, and serve as a lender of last resort. The Federal Reserve System, born from the lessons of 1907, was designed to prevent any single financier or private group from wielding such sweeping influence again. As the new institution took shape, Morgan's era of personal command over national finance faded, replaced by a permanent structure meant to safeguard the country's economy. Today, no single banker controls America's safety net, yet every financial shock still tests the strength of our institutions. With global crises spreading in seconds, the lesson endures. Lasting stability demands more than faith in any one figure. The real question is who we trust next. Share your thoughts below.